Thank you. Thank you. Good morning, everyone. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a beautiful Denver, Colorado. Pleased today to be joined in the chat by my friend and fellow Schwab coach, Barb Armstrong, a fantastic coach, of course, one of our coaches who graduated, if you will, from all of the education here on the Schwab side of things and became a coach herself. Fantastic individual. We're so lucky to have her. So thanks for being here, Barb. She'll manage comments and questions for me that I'm unable to get to live and in the moment with all of you today. But I want to hear from you. So please don't hesitate to drop questions into the chat for us today as we will discuss changes to the market. Bit of a week open this morning following Micron's earnings report after the bell yesterday. We're going to talk about that plenty, and we're going to look at the reaction to the Federal Open Market Committee not making any changes to policy, no rate change at all. And we did hear from Fed Chair Powell afterwards in his comments. So plenty for us to kind of cover and review as we look at the charts today. So make sure that you're following Barb and me on X, Barb Armstrong CS, Kevin Horner CS, and of course you want to make sure you're subscribed to the channel here. So do hit that button on the YouTube side. All right, and with that, everybody, let me take us to our disclosure page, and we'll work through it and dive into the charts. So please bear in mind that our conversation here is exclusively for your information and your education. We do not make recommendations nor endorsements for any specific approach to trading the market here. We will utilize technical analysis as we review the markets today. Of course, these concepts and strategies, these are things that traders may choose to utilize in their own process. We bring them to the table as thoughts for you to consider, but certainly not as recommendations. Beyond that, remember that technical analysis, while helpful and certainly a piece of your decision-making puzzle, should not be the entirety of your decision-making puzzle. So make certain that you are incorporating a multitude of factors as you base your decisions for buying positions and selling stock as well. Now, in our class today, we focus broadly on a review of the broad markets. We do a top-down approach, meaning we're going to start with indices. We'll look at the big ones. We'll move our way through industry groups today because it is a solo chart, their solo opportunity this morning. It's going to require a bit more charts. That means we're going to have an opportunity to hit a number of key areas today. We will dive into sector review as well and look for some stocks in the news. We've definitely got a few of those. But I think the initial thought today is on the heels of, let's talk about it kind of broadly, on the heels of the FOMC meeting and the hold, if you will, on the rate environment has led to a rise in the dollar, has led to some strengthening of the anticipation of yield. So you'll notice the 10-year yield is elevated a little bit. And you'll also notice that the VIX is elevated as well. We're up about 7% on the VIX with the bounce here. Now, for many of you, if you're not new here, if you've been attending this particular class, you know that I've been referencing a look of the chart at the charts that involves. Wow. There we go, everybody. It looks like my chart finally made it. There we are. So this is, of course, the look at the future symbol for the S&P on the left. We've got the volatility index in the middle, and then the oil barrel on the right. Now, remember, when we talk futures, these are certainly not appropriate for all of us, and I just need to remind you that you need to be familiar with the risk and disclosure statement for both futures and options. But the takeaway from this view is the relationship here. Notice VIX climbing and futures on the SPX falling. That's not a shock. That should be normal. But what we've also got is oil playing into the mix quite heavily. Now, oil rallied up to just shy of $100 a barrel overnight, and that put a little bit more pressure on things, but it has stabilized a little. So we're going to keep an eye on the barrel at a $100 level. Over $100 is going to put far more pressure on markets. So we need to keep an eye on that level. We need to know that above that level, you can expect even more volatility as it relates to the US side of things. And you'll see over here on the left-hand side, we got the futures selling down into that 6,600 level right now. So futures are certainly weak. We're off about 1% in the S&P here. Now, one of the other key factors to all of this, as I mentioned, was the rising dollar on the backs of hearing from the Fed yesterday. The anticipation is now for maybe one rate cut between now and the end of the year. The lack of a rate cut weighing on the broader market and sending the US dollar up. Further, normally I would simply lead us with the S&P discussion, but there's something else underlying things here. And with the rising dollar, I think it's important that we look at the metals real briefly, because take a look at what's happened to gold here all of a sudden, everyone. You'll notice, if I can get my symbols in there properly here. Try this one more time. All right. So gold has really, oh my goodness, what is going on? Sorry, everybody. There's a bit of a lag here in my platform, so hopefully I can get my fingers to go a little bit slower. There we go. So here's the move that is significant in gold, and we're going to look at silver momentarily, but take a look. Yesterday we talked about the break of the 50-day moving average and how, closing or trading below the ledge there at about 48.80 would have been significant. Well, today that's exactly playing out. So what you're witnessing here is speaking to that rise in the US dollar, the dollar moving up, putting pressure on gold, probably reasonable that it's putting pressure on silver as well. And excuse me, when we consider the reasons behind this, think about the concept of safety here. If yields are higher, and higher for longer, then traders and investors alike are going to lean more towards the safety of the risk-free return of the U.S. Treasury note, as an example. So you're seeing this getting beaten down. This is a notable breakdown. Now, could this be support? Let's find out. Let's go ahead and let's go back to when gold really got going in earnest in the late summer here. And we're just going to draw a Fibonacci move up to the approximate peak. And I don't think I like that one. We're going to go to the ultimate peak, which was at 56.26. So let's pop it up to there. All right, there we go. So we have encroached with today's low at the 50% retracement zone. That could be support. Does it have to be? You all know the answer to that, I hope. That is no, it does not have to be. So this is a significant development. Hopefully traders along the way have been taking profits, reducing position size on weakness, having a plan as to how they wanted to approach it. But gold breaking down, dollar rising, yields higher for longer, potentially putting a headwind against gold and silver both. Take a look at silver. It's been a little bit more aggressive, everyone. The move here, because of the scenario tied to, obviously, precious metal. Okay, there's one aspect of silver, but so is the industrialized aspect of silver as well. And so if we have broad pressure in the markets associated with individual equities, associated with technology space that relies on silver in certain areas, hey, that's going to put an extended amount of pressure on silver. And that's why you're witnessing it here today. We're off 12% in silver. So not a great look. Hopefully, once more, we traders have been considering the potential risks that have been discussed in this class and others for pretty much year to date. We've been talking about the difference of this market. I'm hopeful that y'all have been defining your levels. You know where you want to be long, you know where you want to be in the market, and you also know when you want to be out of the market. Remember, building cash along the way is a process. It is imperative that we traders are paying close attention. We can get shocked, and as Sam is noting, a rug pull. Yeah, rug pulls are never fun, but it doesn't mean we haven't had opportunities along the way to define our tolerance for risk. We absolutely have in both gold and in silver, and hopefully if you're trapped, let's say, if you've been in a position that's not working for you, my hope is we use that as a learning lesson to not put ourselves in a difficult position in the future. Let's jump back to the S&P 500. Now that we've covered this macro look, you've got the S&P breaking down. We have a gap move below the 200-day. Day one doesn't mean it's over, but let's see about price action on a shorter term basis. We know that the ledge at 58.20 is pretty important, or 65.20, excuse me, because we had that test back here when we bottomed out in November. We made that pretty standard pullback at the time. Let's see, I think this was about a 5% drawdown. Yep, 5.75% drawdown from the peak to the bottom there. That lasted all of about 3.5 to 4 weeks. So no surprise there, but now we're encroaching, or have the opportunity to encroach on it again here, right? And if we maintained 65.20, that would be matching lows. We've said it before, we'll say it once more. Matching lows are okay in the midst of a long-range uptrend. The question is whether we hold that level. It's a very important one. At this point, when we look at the peak that we achieved and we were to come down here, we'll be looking, if we tested it, at about almost a 7% drawdown. And again, we get these 5, 6, 7% drawdowns frequently, or at least we ought to, about once to twice a year. The issue isn't so much that we've pulled back. The question is whether we've pulled back sufficiently. And the thing is, when you look at this over the longer haul, the opportunity for us to pull back to a zone of potential long-term support is pretty substantial, and you'll notice that that's about ballpark to about 6,100. 6,100 is a ways off, everybody. 6,100 would be about 450 or 480 from here, 400 plus points. We're not going to enjoy a move of that nature, and yet the market could easily provide that for us here, to see us go another 6 to 7%. We'd get into that 10 to 12% drawdown level, not the standard so-called bearish move at 20% or anything like that necessarily, but it is something that certainly could play out due to macro concerns, as we know. The conflict in the Middle East has gotten worse, unfortunately, so we've noted that there have been significant moves in energy, right? And you're noticing today energy being one group that's absolutely holding up at the moment. Yeah, we could find some diagonal support, depending on how you choose to look at it. I mean, this is a 5-year weekly. If we were going to work from the lows that we made in 22, for example, and capture the low from the tariff window, we might draw it kind of like so. And it would be great if we just kind of, I say great, it might be more comfortable for us on a day-to-day basis if we simply got there slowly. But I don't know about you all, but it sure feels like the market is much more speedy in its maneuvers, right? We digest news much more quickly, and then we make significant moves both to the downside and then subsequently to the upside quite frequently and speedily. So I think it makes sense for us to expect volatility, expect in the short term that what's been happening is more likely to continue until we get some evidence otherwise. And so for those of us in a day-to-day view of the market, we're going to keep watching that 20-day moving average because we've been below it since February 3rd or so. Excuse me. We had February 12th, excuse me. We really made this significant move. We had the 2 days above it that didn't hold. So ultimately what you're looking at here is 5 weeks below the 20-day with the exception of 2 single days above it that did not hold. Okay, so one more move before we do check out the NASDAQ, the Russell, etc. I wanted to look at this on a shorter term basis. So reminder, if you're utilizing the pivot points along the right-hand side of my chart here, the red, purple, and green lines. These can be used in a short-term basis to kind of give you an example of potential expectation for the day. First of all, we are now below, and have been since all of day yesterday pretty much, below the 20-period exponential moving average. Some traders use this for trend evaluation short-term. But not only are we below it, we gapped today. We did not hold our pivot. Remember what the pivot is. That's the calculation incorporating yesterday's price action, the high and low and close for the day, etc. So this is the price we would expect the indice to trade around for the day. Well, today it gapped below and actually opened below our support 2 level, which is significant. Okay, so we would immediately view perhaps the S1 support 1 level as potential resistance for us. Could be the price level around which we reside today. Notice that it's under 6,600. Remember, with the S&P in particular, we have this tendency to lean more toward round figures. It's kind of a human situation. So understand that any bounce we get from this, and it's already been a decent bounce. I mean, we're up 25 plus off of the intra-period low, but any bounces in difficult markets like this can be quick, they can be speedy, they can even be high percentage, but it doesn't necessarily change the trend. So be aware of that, and you'll hopefully we can kind of keep a little bit of our understanding of how the bias is. Yeah, Barbara, good question. Are the pivots only for short term? They can be applied to your charts where you want them. I utilize them on a single day basis, meaning I'm using yesterday's price action exclusively as it relates to today's expectation of potential short-term support or resistance. Now, that is a study function, though, that if you add the pivot points and you go to the gear, you'll see I tell it, show me only today. But if you say no, it's going to change that, and it's going to give you the pivot levels based on more than just today. So you're looking at for the number of days in your chart. Some traders find that helpful. I don't. I think it muddies up my chart and it makes it more difficult to read, but to each their own. Technical analysis is an art. It is by no means a science. So play with these details at your discretion. And basically, we want them to be offering us individually the signals we want, right? Signals that are helpful. So just one other way to consider it. But ultimately, pivot points can be helpful intra-period for shorter term traders from time to time, but not specifically, certainly not, what would I say? Intra-period support and resistance, short term, that's weak support and resistance, right? Because the broader support and resistance on the daily or weekly charts will matter more, right? Okay. So there's a look at your S&P after a brief discussion on gold and silver and the U.S. dollar. My goodness, it's a busy day. Okay, let's move into the NASDAQ 100 here. We're off about 1%. We've got a green candle because we opened weekly and have pushed higher, but we did fall pretty well, not just through the horizontal support on which we closed yesterday, but through the 200-day. And we've got that low from November back there in the neighborhood of 23,850. That's absolutely worth watching here for obvious reasons, because moves under that level is going to give us a lower low in the NASDAQ 100. That's less than ideal. Let's see if we can't maintain here. Of course, intra-period, you'll notice once more, gapped down to S2, have held it thus far. Any rally into the 20-period exponential moving average could be considered to be resistant. Maybe by the time we get there, we have a little bit of a gap zone to worry about as well. You all know we talk about gaps in this class quite a bit. The importance of the gap tends to act as a bit of a magnet in instances where we get the initial move to the downside and you get rallies. Rallies can happen into the gap zone. So we'll notice that here. It could also just be the scenario whereby we fill the gap in its entirety, right? So maybe, you get into this window here, you actually rally beyond the low of the gap and into the space, into this little vacuum, if you will. So that kind of bears watching on the NASDAQ 100. And with the lack of, well, I should say with some clarity as it relates to the yield situation, you saw Russell open pretty good and weak here this morning off the initial open, but by no means a wonderful bounce, as you can see. So this is a little bit tricky as well right here as we are encroaching upon the 200-day. Now, this is a little interesting because where we've seen the S&P and the NASDAQ now both below the 200-day moving average, small caps are not. So does that mean something different for us? It may. It may mean that we know now still where we're going to be managing our risk. Moves under the 200-day do become significant, but ultimately you're seeing the risk associated with these groups increase with yields remaining high. This is a group of the market that is, of course, tied directly to interest rates, has a lot of significance with rates, especially rates that'll stay higher for longer. Rates that are higher for longer encompass a larger window of time. That larger window of time will likely encompass periods where debt will have to be restructured. And the concern there, of course, is restructuring debt at elevated levels is what puts strain and stress on small business. So we need to make sure that that's not what's playing out, unfortunately, right now, with the concept that we're going to see higher rates for longer. That's certainly the risk. So here's the look at the yield. The 10-year yield rallied pretty aggressively here today. So you've seen some selling of U.S. Treasuries. Notice the level, everybody. We took out the downtrend line. So is that a short-lived situation? Is that a one-day candle above the downtrend line that I've drawn in? I don't know. Is my downtrend line valid? I don't know. Let's find out over the next couple of days. But ultimately, in terms of what we get from the small caps, we'd love to see that yield kind of push back from where it is. Potentially, it could be considered resistance here. This is basically the same high we achieved back in mid-January on the 16th. So if we could get yields pushed down here, that would certainly help out the small caps a bit. Are seeing the VIX drop. So once more, bring back my relationship chart just to see. Yeah, so there's your VIX dropping to an area of potential support. There's your futures on the S&P rallying into that 20-period moving average. Notice that is a down-sloping moving average that's been resistant for us. Whether, very short-lived periods above the moving average here, got to pay attention to this. And let's see, does the VIX come lower, or do we get a bounce in here, right? This is ultimately, we're about to see some clarity for maybe the remainder of the first hour. Hopefully that's a fall in the VIX and a pop in the futures, but that remains to be seen. Interestingly, we're seeing some stabilization of oil here. So let's take a look at the skunk this morning. That would be the semiconductors. We talked about the risk factor here yesterday with Brent, looking at basically the rally after the week open we had on March 9. Let me pull off my all my drawings here, everybody. There we go. So we had this full breakdown, huge bull candle rally into resistance, the 20-day moving average here. So if I zoomed in, this candle was great, right? We had a bull engulfing candle at an area of support, and it lasted for a day and a half, right? You got the follow through at the open, but it was a weak finish. We tried to push higher the very next day, weak finish. And now what we're witnessing, we've got the 20 crossing the 50 to the downside, and our rally that put us in there was very short. short-lived. The concern here today, if we called yesterday's high the high in our snapback, well, then we traded through the low of our high day. The first signal that bulls might use to take profits or to pull position size from the trade, because you've broken the very brief uptrend there. You now have traded through the low, which could mean more selling before we get back above the 20-day. This is not the development we're looking for from the semis. Obviously, this is tied quite heavily to Micron and their announced earnings after the bell, which we will talk about. But skipping this into the 15-minute bars or maybe the 1-hour bar here, let's see. Want to get a little bit of clarity about whether we've maybe found some semblance of short-term support, but it's going to take a second here. Everybody apparently doesn't want to give me my 1-hour bar. Give it 2 more seconds. All right, doesn't like it. So back to the 15-minute. I'm going to add a couple of days here. I'm on the 5-day 15. So that very brief uptrend line I drew on the daily chart, that's this white line here. And then the line here, this horizontal line, this is the low of our high day in the rally. So the oval here, this is, of course, the 2050 oval I drew in, right? The crossing of those two lines. But this is basically the low. So what do we have? An uptrend line in the short term that was support, and we're under it now. That could be resistance. So if I was to color that red, some of you might utilize a look at that and say, okay, as nice as this has been off of the low, we've managed to pop up quite nicely here about 120 points real quickly. We could rally into the red trend line there and find that to be resistance. We could also rally into the 20-period exponential moving average. If this is a new short-term or new downtrend for us, this is going to be significant. Can we get back above this breakdown here? Okay, so intra-period, very important level to be kind of monitoring. All right, now with oil going the way it has, we've noted that the transports have really struggled. They fell out of favor here 2.5 weeks ago. That should not be a surprise given the nature and the time frame associated with with this conflict going on. So transportation has really seen the significant shift. Your groups in transportation, like our rail stocks, pulling back dramatically, probably more tied to the slowness of the market of our economy suddenly, right? If inflation pressures persist, and we certainly heard that from the PPI number this week, well, then what is apt to occur? It's more likely that we witness the broader economy taking a bit of a breather or slowing down a little. Now, we could say that we are encroaching upon the bottom of a channel that we were above very briefly, and that would work out. I mean, there's some confluence at the 200-day moving average right here. Potentially, we'll see rail stocks come into support here. Now, let's do the same, but let's check out the air stocks. So planes have had a similar move because, of course, gas, right? Fuel prices increasing, not great for airfare. There was, excuse me, here locally in Denver yesterday, we had a power outage, and at the airport, and Denver International had a little bit of a difficulty for about, I guess, 90 minutes or so. But look at what's going on here. This is a pretty healthy move in the space, everyone. We've had this got a little ahead of things. So mid-February to our bottom here, the airline stocks, 27.5% to the downside. But could it be an area of potential support? I think a lot of traders would say, yeah. And it has bounced. So maybe there's a level that we know about now where traders would get more defensive, and that would probably occur under that white line, right? Under that white line, you've got more risk. And I tend to agree here. Let me see I saw some comment about, yeah, Sam, this is suddenly a weak market, a risk-off market. It's not wrong. I hope you guys have been kind of heeding some of the commentary that we've been watching, right? We've been looking at some very basic technical analysis details in a lot of these broader areas, and it's been a little bit foretelling, right? We know that when we're not making higher highs, but we're making lower highs and lower lows, that we're in a shorter term, at least, weaker market. And can't say that we knew breakdowns were coming, but we knew that the market wasn't as strong as it had been, right? And so we take note of that. Hopefully we build that into our thought process a little bit. Here's the look at the trucker space. Truckers have pulled back dramatically as well. Significant, right? Now, some of you are noting software seems to be working. Let's take a look at software here. First of all, let's pull up tech. So tech a little weak. We broke, hey, that's a new short-term low. Obviously, we would love for this candle to stay green for the day, work its way back upward into the area where we've kind of had a lot of congestion for the last couple of months. But I agree, Kelly, bear flaggish, right? In a lot of these scenarios, and trading to new short-term low is definitely not ideal. But if it is a low that gets bought up by the bulls, then it can be or potentially be a snapback move. But ultimately, everyone, we're not going to feel good about tech until we're back above any of these moving averages. We are below all three, below your 20, which is crossing the 200 to the downside, below the 50 and below the 200. And we're in danger of seeing the 50 cross the 200 to the downside for a potentially longer term drawdown in the eyes of some traders. Now let's look at software in here. Whoops, I hit the wrong button there. Sorry, everybody. All right, so let's see. Software. Okay, software's up a little. Okay, but I say up a little, but we're basically flat. Had a weak open below the 20-day. We were thinking we could hold the 20. Now, could we be seeing the potential for software to be a relative strength performer or an outperformer versus the rest of the market? Yeah, that's a possibility, but it doesn't eliminate what's already occurred, right? It could outperform going forward. That remains to be seen. But the reason that it could outperform maybe going forward is because we've seen a re-rate, if you will, of software. Look at how significant the move has been. We have seen the group collectively drop 33% plus. So we've basically seen a bear market in software already. Software led us lower. If what we're witnessing is the short-term bottom in the market and it holds, then we could expect our weakest group initially to provide maybe a little bit of short-term relative outperformance. Okay, we're going to see, James, maybe we've already seen the relative panic associated with software, right? That's a possibility, which is maybe why we're here in the first place. So we'll keep an eye on this. As always, software, very important. But I wanted to talk about Micron with you all. A couple of key components about Micron that are notable, I'd say. So we had a good report from Micron. So Micron, let me give you a little bit of data here on Micron specifically. By the way, they were downgraded at Summit Insights, downgraded to hold from buy, said the firm's expectation for stock in Micron's outperformance in the second half of this year is kind of moderating. That's because that Summit Insights adds that while it sees favorable memory demand and supply dynamics and pricing through the rest of the first half of this year, they also believe that price increases will likely decelerate meaningfully as we move into the second half of the year. Now, the thing that stands out to me that I don't enjoy, and I think a lot of traders are wondering about, Micron reported really great earnings, right? They guided higher, 42% above consensus on gross margin, above consensus, on revenue, and their gross margins guided to 81%. It's basic. I mean, these are great numbers, everybody. These numbers were fantastic. What's not fantastic is the reaction to those numbers. So when we start seeing excellent data that is not supported in price action, that creates a concern. So we need to be aware if I'm looking at this particular chart, the thing that stands out is the exceptional move to the upside that came with a validated RSI into overbought conditions. This last move, excuse me, did not. So notice the level here, much below got up to about 65 or so before pulling back here with today's move. Now, it is true to this point, we have basically tested that level, right? Right on the 20-day, right on the downtrend line. This could work out to be just fine, but it remains to be seen. But again, the takeaway for me was negative price reaction following an excellent move or an excellent report, I should say, out of Micron. So we don't like it when the market gives us good news that is digested negatively. What we do like is when the market gets negative news that is digested bullishly. That could be positive and optimistic. So we'll keep an eye on Micron. There's every opportunity for it to continue to provide some leadership in the market here. You'll see we're pushing nicely off of the intra-period low to this point. We might be looking at short-term opportunity here, but let's see. It held the open ledge here at the support 1 level. It'll be very interesting to see how we act up here if we get to the true pivot based on yesterday's price action at around 452. A rally into 452 that is rejected would be less than ideal on a short-term basis here as it relates to Micron. And of course, weakness in one of your bigger positions after a significant report, it can spread. Okay, so it's possible that it's not simply Micron driven. So there's been big moves in both Micron and SanDisk, and let's see how just for the heck of it, let's see how SanDisk is looking here this morning. See, that's a lovely reaction off of a weak open there. That's pretty notable. Boy, that was a great bounce off of S2 as it turns out, and right through the pivot. So a fantastic snapback in SanDisk so far. Keep an eye on that one those charts look pretty darn similar, don't they, everybody? Interesting stuff there. Okay. Yeah, Kev, let me speak to that for you. Let's pull up utilities. Since I wanted to answer some questions here. So Kevin's asking about higher rates pushing utilities lower. Could today be a higher low? It could be, right? I mean, look where we opened. It is a low that is higher than the last one we made. The moving average situation here is not really offering us as much as we might like. We do have horizontal support here, but with the rates elevating, you might very well expect that this bounce to the upside in the first 37 minutes of the session may not very well hold. Let's see how that goes. But obviously, we would be, if you're in utilities, the thought is as yields stay higher for longer, yes, I think it makes sense to have a thesis that suggests utilities would be more apt to struggle if yields are going to remain higher. The same could be said about REITs as well. And notice that REITs got thrown all the way back into that same range that we've been talking about. We were basically in a range there for 9 months or so, and we are right back into the range. So all of that breakout, none of it stuck. So difficult, to say the least. Good question here, Zink. Is the market starting to price in this war going longer than initially expected? I think that's absolutely what's going on. When you listened to Fed Chair Powell yesterday speak on the risk factors associated with the war, it's a lot of uncertainty, right? What do we know about the market, everyone? We know regardless of trend, the market does not like uncertainty, and uncertainty has been weighing on us. So yeah, it's unclear. But more specific than that is the inflationary pressures. So once more, as oil goes, probably so goes our market. So if oil continues to stay elevated, there's really no way around it, everyone. If oil stays elevated, our inflationary pressures remain elevated, and that's a key component to reasons for institutional investors in particular to pare back on their investment, right? They're not going to be able to anticipate margins continuing to expand if inflation is continuing to stay sticky. Now, it's true we didn't hear any certainty around inflation, but the breadcrumbs from the PPI this week, higher oil, and the evidence of oil staying elevated beyond 90 for the last 6-7 sessions now, not great, right? Less than great. So pay attention to oil. It's going to have an impact on our markets as we go forward. Energy as a sector holding up quite well. As you can see, those are new highs, continuing to ride that 20-day moving average to the upside here. We may be due for a breather, but I'm always hearkening back to my man Lee Bull. New highs are not bearish. So when you see a group as significant as energy continuing to do what it's done on a year-to-date basis, we have to take note. Energy, 31.5% year-to-date. That is an crazy move, everyone. So yeah, we could be in for a bit of a struggle here if we're going to continue higher in energy pricing, and that speaks to the inflation story. So if you're a trader, all right, one of the things to bear in mind is, once more, we have to move where the trends are. Where are we trending bullishly to take advantage of our opportunities? Well, it's not in financials, it's not in discretionary, it's not in tech, even though for the better part of the last 3 years, it has been in tech and financials and discretionary, right? We've had exceptional returns, but it is your job as a trader to move with the market. Don't get settled into trading the things that you've traded in the past just because you know those symbols or because you feel like you know the price action. All right, you're falling victim to a new chart, a new pattern, a new trend. All right. And if you're changing your thought process and saying, yeah, what was working last year is no longer working, therefore I'm going to hold for a longer window of time, well, then you're reacting to your losses and deciding to anchor those losses even longer. I would challenge you to make sure that you're following a plan that gives you comfort and confidence in the market. Going where opportunity is key to that process, though. Yeah, every time I mention Lee, I see the same stuff. Yeah, Lee was awesome. He still is. Great guy. I miss Lee all the time. Same for Ken, Ken Rose, Pat Mullally, these guys that are enjoying their retirement. Yeah, they're all doing great. I get to hear from periodically from Pat and Ken Rose as well. Ken's still out there on X, for those of you, by the way. He posts kind of frequently throughout the week as well. He's still paying very close attention to what the market is doing as well. Yeah, and Rita, from a standpoint of trade management, I like your concept here, especially with energy, notably. If you're a trader who's been watching this, you've had plenty of reason to stay with your position because it hasn't closed below the 20-day moving average. So what are we talking about? Potentially changing that when trade breaks down. So a close below the 20-day would be a development that would give bullish traders reasons to build some cash, right? Take a little bit of profit off the table. But some of you like to sell into strength, and there's nothing wrong with patting yourself on the back, especially if you've been in the energy trade dating back to December or just January, and you got long in the beginning of January, and you're up, at this level, you're up 30%. If you're up that much, it's okay to take a very small position off. I mean, maybe you're thinking 5%, maybe 10%. Pat yourself on the back and be reminded of your process. It's good to reinforce your trading behaviors, everyone. So I hope this was helpful. I know that we usually end the conversation with a little bit more link into what's really going on with individual equities. And the big one I wanted to talk about was Micron today, of course, in terms of individual equities. But this is a tricky market, to say the least. I hope you're watching a lot of the opportunity on the channel here to kind of stay apprised of what's going on, or maybe learn about a strategy that you haven't previously incorporated. The market will give you opportunities to try new things, and perhaps that's what we're in the midst of now. If you've been bullishly trading the market for a while here, maybe now we're undergoing a little bit of a breather for the first time in a while. Hey, look for those opportunities to find ways to participate in the market that might fit this style of market, as opposed to what we've been doing all the while. So hopefully that's helpful also. Now, for the remainder of your day, we're busy on the channel. We've got live classes between now and the end of the day. So keep it tuned right here. Follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS, and make sure you're subscribed to the channel, everybody. I'm going to get this class reviewed and into the archive as soon as possible. So if you liked our discussion, hit that thumbs up for me. We'll get that. That'll help us out in the algorithm when we get it available for replay. But as always, I appreciate you joining me every day that I'm here with you. Monday, Tuesday, Thursday, Monday, Wednesday, Thursday, and Friday. Now, tomorrow I'll be back for ETF day on Trader Talk. So that one, remember, you got to be here live. So with that, have a fantastic rest of your Thursday as the NCAA tournament kicks off today. Hopefully you get a little chance to watch some hoops, and I look forward to catching up with you all again real soon.